All right, I need you to listen to this right here. Have you ever been played by Forex? And I'm not talking about, brokers or anything. I'm talking about the markets doing something that completely takes you out of a trade. And I'm going to expose, Forex's dirty little secret, something that you'll never ever be really taught in your generic rooms. They'll teach you breaks and retest and things like that, but they'll never teach you exactly what I'm about to show you. And for good reason, because they don't want everybody knowing what this is. But if you pay attention over the next 5 minutes, I'm going to show you something that would probably blow your mind away. Now, if you've been trading Forex for a while, you know that the markets move in sporadic ways sometimes. There's some instances where the markets move in sporadic ways. And for new traders, that could be something that makes them afraid. But what if I expose that a lot of Forexes or institutional banks' dirty little secret when it comes to trading exists in something like this? A candle or a candle set exactly like this. Now, why is that important? Why is two candles important like that? Well, you got to look at psychology because institutional banking basically plays on the psychology of normal, average, everyday traders. So here's what I mean by that. Most traders, they're taught, support and resistance. So they're taught support and resistance. So basically, if they're trading, they would see something like this and this downtrend, and they would basically, mark up support. Most traders do, but there's nothing wrong with it. But what happens is a lot of traders trade, they over leverage, they, you know, try to be in perfect positions, and the banks know that. So say you're let's kind of replay this. Say you're going into your trade, you're seeing that there's a downtrend here, and you're looking at this break and retest, and basically, markets they break down. You sold here, got a little bit of profit here, and what do you do? Most traders, smart traders, or you know people that are a little bit adept within the retail mind, what do they do once price starts to go in their favor? They'll put their stop loss right above their entry or right at their entry to mitigate losses, which is the correct thing to do. But what happens is the banks know that a lot of traders have put their stop loss right here. So what happens is the banks push the market up. They start to slow down. So they think that traders are now thinking that they have a second chance to sell and go down. But they're accumulating orders in this area. That's why the markets haven't been moving. And then all of a sudden, market shoots up, triggering the stop losses of all these different stop losses. Triggering the stop losses there. They basically buy into the market and then immediately sell off, create a sell, and move the market down. The institutions are the ones that move the market. But this right here, this little move right here is called mitigation. And if you ever see something on the charts, and you'll probably see it once now that I'm teaching this to you, you're going to notice it a lot more often than you think you will notice it. So mitigation, basically they're buying into their positions to mitigate and sell down. So the other part of mitigation is because this little buy is still open. When they do this move, they keep this buy open because they don't want to mess up the charts. So they keep this buy open. So now they have a buy. And if I take off some of this so you can see it, if I mark out the open of this candle, I want you to pay attention to it as I go further in the charts. So I mark out the open of that candle. Oh, the candle opened right around here. And basically, what happens is the banks want to push down the market. They're making this move here, push down the market, and they start to take profit. Right here is when they start to take profit. You see that buy candle. They're taking profit, and they're taking small amounts of profit, and then they'll take a bigger amount of profit. And once their buy position is completely, I guess, closed out, and the market starts to resume back in this direction, because in order for them to take profit on a sell, they must buy. So, but here's the thing, this buy order is still open. So they're in drawdown for this smaller order. Even though they had the bigger order here, they're still in drawdown for the smaller order. And banks don't like to just lose money. So what they'll do is they'll push the market back up, and they'll push the market back up right into the opening of where that original buy happened, right to the opening. And then what happens is they accumulate orders. They wait for more people to start buying into it, thinking that this is an uptrend. And then this happens. They sell right off of this order. A few pips, 3 pips of difference. But right off of that order is when they sell. And they sell, they get one position, they get two, and then they make their big position here. And then they sell down. It happens over and over and over again. So I want you to go on the charts, whenever you're watching this, go on the charts and look for candles that break. You see this zone here. Look on the charts and find little zones like this where it's consolidated or there's equal highs, and look for a candle to just break that. And then watch the move that happens after it. And you'll start to notice a pattern that it'll be a candle like this that basically screws all the traders over, triggers stop losses so they don't catch the profit that they had in mind when they sold over here. So if you like this video, if this made sense to you, definitely like and subscribe to this channel. I'm going to be making a lot more videos like this so you know exactly how to avoid the trade traps of institutional players in the market.